Trump being back in the White House have brought bold prescriptions for America's future and uncertainty on where they lead. Will it be growth and prosperity or stagnation and decline?
I'm Liu. Today's question we are exploring is, could Trump's domestic policies and tariff measures become the trigger for the next global financial crisis? Our analysis covers how Trump's policies could push the US to the edge of recession, how these risks could spread worldwide through the network of globalization, whether countries can collaborate on policies to avoid the worst outcomes.
I'm Ming Chun. Let me explain the risks of Trump policy triggering a U.S. recession. The first risk is the fragmentation of tariffs and trade. Donald Trump's 2025 tariff policy, which includes a 10% base tariff on all imports and a 10 to 50 reciprocal tariff on 60 trade deficit partners, will cause serious supply chain disruptions. To avoid high tariffs, companies will move production from China to Southeast Asia, such as India and Vietnam. However, due to infrastructure gaps, production efficiency will be greatly reduced. In addition, the 2025 measures may accelerate inflation, which may increase consumer costs by $500 billion per year, disproportionately do harm to low-income families and suppress the demand. When it comes to domestic economic contradictions, thanks to our team member Weijian for his research, he found that Trump's policy combines tariffs with a proposed 10-year $4.5 trillion tax cut, creating a financial imbalance. Tariffs only generate $142 billion in revenue each year, which is not enough to offset the impact of tax cuts. The resulting butterfly effect, the U.S. deficit may exceed 6% of GDP, triggering volatility in the bond market. While tariffs are intended to revive manufacturing, sectors such as agriculture are facing retaliation. The trade war in 2018 to 2019 led to a 24% rise in farm bankruptcies in the United States, which is a trend likely to repeat itself. Moreover, Trump's tariff policy is similar to the 1930s Moved-Hawley Tariff Act, which triggered the retaliatory tariffs from various countries and caused global trade to plummet by about 60% over the next 4 years. In addition, this has led to a decline in corporate profits, a surge in unemployment, and aggravated the economic crisis. In addition, if interest rates are raised to curb inflation, the ratio of corporate debt to GDP may become unsustainable, resulting in a debt crisis.
Moving on, I would like to continue with the global crisis contagion mechanism. The path to globalization of crisis divides into 3 parts. The first part is currency wars. The European Union and China may resort to competitive currency devaluations similar to the hedge fund's attack on Thai baht's fixed exchange rate, triggering turn-on in global currency markets. The second thing is that the chain reaction of financial markets and a 15% drop in the S&P 500 index could trigger a global stock market sell-off. The high degree of interconnectedness between banks exacerbates financial market instability, creating the 2008 subprime mortgage crisis. Last but not least, the commodity price shock. The increase in energy import tariffs had led to a 10 to 15% increase in global energy costs, similar than the stagflation in the 1970s, which has put significant pressure on the global economy. Moving on to systematic vulnerability. First thing is emerging market debt. Second thing is derivatives risk. And last but not least, currency wars. Starting with the first thing, Vietnam, Mexico, and other countries are facing payment crisis, and the IMF estimates that they will need to provide $200 billion in and by 2026. For derivatives risk, unregulated CDS threatens financial stability. A 20% drop in US stocks could trigger $1 billion in payouts. Third thing is currency wars. The EU and China may resort to competitive devaluation. That's similar to the speculative attack on the Thai baht in 1987. Lastly, I'll talk about geopolitical influence. The first thing is swift alternatives. The weaponization of the US dollar has accelerated the development of systems such as CIPS, and global liquidity may decline by 12% to 8%. Then its trade group recognized reorganization. RCEP and EU-China cooperation could marginalize the United States, with its export share falling to 8% of GDP. Then moving on to financial fragmentation. Trade barriers deepened the segmentation of financial markets and increased uncertainty to global capital flows. Last but not least, strategic alliance changes. Emerging markets are seeking new partners, reducing their dependence on the US market and reshaping the global trade landscape.
So here we come to the policy recommendations part. Today we will discuss essential domestic policy adjustment for the US government to mitigate crisis risk. First, we lead a precision tariff strategy instead of broad tariffs. We should adopt industry-specific tariffs under WTO rules, focusing on sectors like semiconductors. This target approach will help reduce collateral damage to the global economy. Next, we must emphasize strengthening fiscal discipline. By combining tax cuts with strict spending caps, we can maintain deficits below 4% of GDP. This strategy builds on the principles of the Budget Control Act, ensuring responsible fiscal management during challenging times. Finally, we propose a debt risk management strategy. Establishing a bad bank to handle high-risk corporate debt will be crucial. This initiative, modeled after the 2008 TARP program, aims to stabilize financial markets by isolating troubled assets. Now, let's turn to the international coordination and cooperation. Firstly, the Federal Reserve should expand currency swap lines to emerging markets such as Vietnam and Mexico. This move will enhance financial stability and liquidity during times of crisis, drawing lessons from past experience. Next, we lead WTO reform. It's vital to revise the dispute settlement mechanism to introduce a tariff escalation clause. This clause would require multilateral approval for tariffs exceeding 15%, promoting a fairer trade environment. Additionally, we should implement a green stimulus package. A coordinated investment of $500 billion annually in renewable energy through the G20 could create 12 million jobs while offsetting trade slowdowns and driving sustainable growth. We focus on strategies for emerging markets. To start, export diversification is crucial. Southeast Asian economies should aim to boost intra-regional trade to 40% by 2030. Aligning with ASEAN's integration blueprint, this will help reduce reliance on external markets and enhance economic resilience. Next, we recommend capital controls. Implementing a short-term capital inflow reserve requirement, such as 30%, can stabilize currents and mitigate spectacular risk. We should also accelerate CBDC adoption, promoting central bank digital currencies like China's eCNY. Will facilitate cross-border transactions while reducing dependence on the US dollar. Lastly, we need to strengthen regional cooperation by enhancing inter-regional policy coordination. We can better address external shocks and build a more resilient economic framework.
To conclude, Trump's tariff policy poses risks to the US economy and could trigger a global financial turmoil. As a solution, domestic policy adjustment, international coordination, and emerging market self-protection are needed. Furthermore, historical events stresses the consequences of market manipulation, and hence call for multilateral cooperation rather than unilateral actions. To conclude, Trump's tariff policy poses risks to the US economy and could trigger a global financial turmoil. As a solution, domestic policy adjustment, international coordination, and emerging market self-protection are needed. Furthermore, historical events stresses the consequences of market manipulation, and hence call for multilateral cooperation rather than unilateral actions.